Most investors think rental property underwriting is just about credit scores or rent numbers. It isn't. Underwriters evaluate rental loans using a full risk framework, one that most borrowers never see, but all borrowers feel when their loan gets delayed or denied. Today, you'll learn exactly what underwriters look for in rental property loans, how they think, and how to prepare your file so you look like the safest borrower in the stack. Let's get into it. 1. They start with the DSCR. Does the property pay for itself? For rental loans, DSCR is the heartbeat of underwriting. DSCR equals rent divided by mortgage payment. If the rent comfortably covers the loan, underwriting flows. If the DSCR is tight, or worse, below 1.0, everything slows down. Most lenders want a DSCR of 1.0 to 1.2, depending on risk. Underwriters use the DSCR to answer one question: is this asset strong enough to stand on its own? 2. They verify the market rent, not the rent you want. Underwriters don't use your projected rent. They rely on the appraiser's 1007 rent schedule, which analyzes rent comps. If the market rent is lower than your expectations, your DSCR drops, and so does your approval strength. This is why investors fall in love with deals that underwriters reject. Numbers don't lie, and appraisals don't care about your optimism. 3. They analyze property risk. The neighborhood matters. Underwriters evaluate the asset, the location, and the stability of the income. They look at vacancy rates, market condition, crime trend, tenant demand, property condition, WA strength. If applicable, a solid rental in a strong area gets easier approval. A shaky neighborhood requires stronger DSCR, better credit, or more reserves. 4. They check your liquidity. Can you survive problems? Even if the property cash flows, the underwriter asks, can this borrower handle a vacancy, AC failure, or sudden repair? Lenders want to see bank balances, reserves, accessible credit, seasoned funds, not last-minute deposits. Liquidity equals stability. No liquidity equals risk. 5. They review your credit, but lightly. Rental loans don't require perfect credit. Most lenders accept 620 to 680 plus depending on leverage. Underwriters look for no recent major lates, no open bankruptcies, no unresolved collections, a pattern of responsible behavior. They don't need perfection, they need predictability. 6. They evaluate your experience level. Experience reduces risk. Experienced landlords handle vacancies, contractors, tenants, and repairs more efficiently. If you're new, the underwriter checks your support team, property manager, contractor, realtor, mentor. Experience can be borrowed from the team around you. 7. They study your global debt load. Even though DSCR is property-based, underwriters still check your total debt. They want to confirm you're not over-leveraged across your portfolio. A borrower with 10 rentals and no reserves gets flagged fast. A borrower with 10 rentals and healthy reserves? Strong approval. 8. They validate your exit strategy. For DSCR loans, the exit strategy is usually long-term hold, but underwriters still want to see logic. If the market shifts, can you maintain the loan? If taxes rise, does DSCR survive? If repairs hit, do you have reserves? Underwriters approve based on the realistic future, not the fantasy one. 9. They grade your documentation quality. This is where many borrowers fail. Underwriters pay attention to missing pages, unlabeled documents, blurry screenshots, conflicting numbers, multiple email threads. Nothing collapses confidence faster than inconsistent documentation. Clean files get approvals. Messy files get conditions. Here's the payoff. Underwriters don't fund the perfect borrower, they fund the prepared borrower. If your DSCR is strong, your liquidity is healthy, your documents are clean, and the property performs, you'll get approved smoothly. If you know what they're looking for, you can give it to them before they ask. Subscribe for more science-backed insights on personality and decision-making. Educational content. Not financial, legal, or lending advice.